Tax time can be a little intimidating for active traders, whether it's your first or 10th time filing. Organizing all your accounts and figuring out the gains and losses can be a tedious process, but it must be done. And we're here to make it a little easier with some tips. I, along with the others at IBD, are not tax experts, so please remember to do your own homework, your own research. But here are a few pointers that may make the process a little easier. First of all, having a dependable record-keeping process is key to making things easy at tax time. You may be managing multiple accounts for various purposes, and it's important to note which of those are tax-free accounts and which aren't. For taxable accounts, be sure to track your trades each month. This way, at the end of the year, you'll have exactly what you need for tax reporting purposes. There are some great software products available that will download all your trading data and do this for you. Just a quick web search and you can research some options to find out what works best for you. But for peace of mind, it may be smart to do it both manually and with software tracking as a backup. As active traders know, you get a consolidated form from your broker that shows every single trade you've made that year. On this form, you'll have what's called your gross proceeds, which shows how much stock you sold or bought in the past year. So if you have, for example, a $100,000 account, you could have traded millions of dollars worth of stock that year. You need to tell the IRS how much you made or lost on all those trades. For example, maybe you made $30,000 on that $3 million worth of stock traded that year. This is why having a software platform to track everything can be super helpful. It simply looks at your account data and tells you what your purchases, sales, and gross proceeds should be. Then you simply take that data and match it to what your broker sends you. Another tip is to be ready for the amount of time it will take you to do your taxes, whether you're working with a professional or not. Be sure to be detail-oriented in this process. There may be a discrepancy as what your broker sends you may not always be 100% accurate. If there is an error, be sure to contact your broker to find out exactly what the mix-up was. Another thing that may come up with active trading is wash sales. These will certainly impact not only your trading, but how you deal with the tax process at the end of the year. For context, a wash sale is when you sell a stock at a loss, but then turn around and buy the same stock within 30 days. For example, say I buy 100 shares of XYZ stock for $10 a share, a total of $1,000. Then the stock starts dropping and I decide to sell the 100 shares for $8 per share, giving me a loss of $200. 3 weeks later, XYZ is trading at $6 per share and I decide to repurchase the 100 shares for $600. This triggers a wash sale. As a result, I won't be able to claim that $200 loss as a deduction on my current year tax return. It is then added to the cost basis of the repurchased stock. Investors must be aware of wash sales and how it will affect decisions. Side note, IBD founder William O'Neill wasn't really concerned about wash sales. If a stock triggered a sell rule, he sold it, and if it presented a proper buying opportunity a few weeks later, he would buy it without being concerned about the tax implications. He considered taxes the cost of doing business for a trader. Another thing to be aware of is the trader status rule the IRS has. This status means you're an active trader, you're not subject to the wash sale rule, but you also cannot claim a long-term capital gain. So, if you're a super active trader and you know that you will never hold anything long enough to get a long-term capital gain, then you may consider trader status with the IRS. The thing to be aware of with this rule, however, is that it's not a black and white rule. There's no definition that says if you do 30 or 50 trades a month, then you can claim the status. It's just a general rule that if you're active in trading securities, you may be able to claim it. At this point, it's clear the benefits of using a tax-free account with your trading, as you wouldn't have to worry about any of these things that we've discussed so far. One such tax-free account you may have heard of is a Roth IRA. Investors are allowed to contribute to this type of account with after-tax dollars, and they allow your investment gains to accumulate tax-free. Basically, you get compounding interest to work in your favor on money that would have normally gone to paying taxes on gains. Investors should also be aware of if you're required to pay estimated taxes quarterly or midway through the year. Otherwise, you may be subject to penalties. Be sure to check irs.gov for more details on if that's also something that you need to think about. All in all, investors should remember that taxes are, like IBD's founder believed, just part of the cost of doing business. Taxes shouldn't impact your trading rules and philosophy. that lay at the core of your trading practice. Always make sure that you pay attention to your proper entries and exits and stick to your rules as much as possible, even if wash sales do come into play.